Hi everybody, today we will go through the best book written on Warren Buffett's investing style. So for the last years I've been studying Warren Buffett and his partner Charlie Munger, their ways of doing business, investing and life. And it has been a really fascinating journey and I've learned so much from them. And recently I came across one book that has been the absolute best book written about the style of investing of Warren Buffett. And that is after watching all of the recordings of Berkshire Hathaway's annual meetings, reading many books about Warren Buffett and watching so many videos and interviews. And this book has been the most helpful. And so I want to share the ideas with you here. So the book is called The Warren Buffett Portfolio and it's written by Robert G Hagstrom. And why I like this book so much is because Robert Hagstrom, he's really so good at laying out all the fundamentals of how Warren Buffett thinks when he creates his portfolio and when he analyzes companies and his ideas on investing. Robert also describes and explains these concepts really well, that is really easy to understand rather than making as a large book as possible. Something that we learn in the book is the idea of a focused portfolio, a collection of a few great businesses bought at reasonable prices. And this is a little bit opposite compared to the diversification that many talk about, that we need to own many companies to diversify. So if one company produces bad results, we have tons of other companies that produces okay results. So the diversification is really created in order not to have a terrible outcome, but we will never have a fantastic awesome outcome. I like describing this as having an art collection. If you have a few paintings in your house, the same could be true for having a collection of those businesses. You really want to choose those businesses wisely, choose the ones that you like the most and not pay too much for those. And while a collection of paintings only sits there and you never really know what's going to happen with their value, a great business will produce earnings. It will probably grow for a long time. So having a collection of great businesses, holding on to them for a long time can really be a great idea. One of the reasons why Warren Buffett has been so successful when it comes to investing is because he thinks differently. He thinks differently than most average investors, and he even thinks differently than how investing is taught at most universities. So that's why he has been so successful. So we will look at some of these polar opposites about what the conventional idea is about investing and what Warren Buffett thinks. So the conventional idea about investing is that all stocks, all shares, all companies in the stock market are efficiently priced at all times. And you're never really able to make a good deal. You cannot buy a company at a discount because the market is always analyzing these businesses and is taking into account how much the company is earning, what the future looks like for this sector or for this business. And therefore it's impossible to pick up a stock or buy a business below its value. Well, so that's the conventional wisdom. Warren Buffett, on the other hand, he thinks that the market is efficiently priced most of the times, but occasionally it's not. And what does that really mean? That means that occasionally the market is really overpricing, it's overvaluing that company. And occasionally, if a business and a stock is crashing, the market is really underpricing that. It's undervaluing that company because the market is usually over optimistic or over pessimistic, or something is happening in the global economy, or some event is happening, or the company has temporarily a bad CEO, for example, and then the stock price plummets. And Warren Buffett, he recognizes that during these occasions, it is possible to buy a company for a great price, where what he thinks is the value of the company, the intrinsic value, is higher than the actual stock price, what the market values this company at. Another idea from conventional investors is that volatility is something bad. And that basically means if the price goes up and down a lot. And they even make analysis if a company is going up and down more in price than the market itself, and then they will say that this is a more risky stock, this is a more risky company, a more risky investment. Warren Buffett, on the other hand, he invites volatility. He likes volatility because if the stock price goes down, then he says, well, if this is a company that I like, that I already have in my portfolio, it's a great opportunity to buy more of this stock. So he is not afraid of volatility and price changes. He actually embraces that and loves that fact. So another idea is that most investors are absolutely obsessed and addicted to the stock market, to the actual prices, and look at it several times every day. They maybe have big screens looking at it constantly, many times per day, and they are addicted to seeing if what they have bought is going up or going down. And if it's going up, they feel great. If it's going down, they feel terrible. Warren Buffett, on the other hand, he's totally detached from the stock market. What he focuses on is the actual businesses that he buys. He sees every stock as part of a business, and the investments he makes is due to he sees that as a great business. He loves that business, and he analyzes how well that business is doing. So is there a growth in earnings? Can they lower their costs? Many of these different statistics that actually say if it's a good business or not. If you would run your own business or look to invest in a privately held business, that are the details that you would be looking at. You would be analyzing how well this business is doing, how much profit is it producing each year, what are they doing with that profit, are they investing intelligently for the future, or are they just paying out a really high salary to the CEO and to the managers, or are they distributing that to the shareholders, or are they reinvesting that into the company, and are they getting a good return for that money? So when Warren Buffett looks at a publicly traded company in the stock market, he looks at businesses exactly the same way. So he detaches himself from the stock market and the actual day-to-day price, and more focuses on how well the business is doing and how much profits they will produce for the future. So there's a quote by Buffett in the book: "The goal of each investor," says Buffett, "should be to create a portfolio, in effect a company, that delivers him or her the highest possible look-through earnings a decade or so from now." So Warren Buffett looks at how much money are these companies actually earning, and how could he make purchases decisions, investment decisions, so that for the money that he puts out, the money that he's investing, how can he make sure that that is producing the highest earning within that company in 10 years or so from now? Those are the questions that he is asking himself. And that is a very contradictory view. That's a very different view from how most investors look. The average investors just look at, okay, these companies are going up, I better jump on that train so I don't miss out. And they have no clue how much money those companies are earning and what the actual real numbers are, how well they are doing. They just see if a stock is going up, then they want to jump on that train as well. So they are totally addicted to price, while Warren Buffett is focusing on the fundamentals, on the businesses itself. And one should remember that this book is for the active investor, the one who wants to make their own decisions regarding where they put their capital to work, while most people who don't know anything about investing should invest probably in a low-cost index fund and invest back money into their own education and how they can increase their productivity and increase their income and so forth, because that will have the highest return. But for those who are interested in how Warren Buffett thinks, how he allocates his capital, this has been the best book so far that I've read. And because Robert Hagstrom, he explains it in such a simple way and takes complex ideas and makes them easily understandable. Thanks so much for watching. Have a great week and see you next week.